Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson. Adrian, I'm looking forward to the episode today.
I got a fun topic for us today. I'm going to be talking about some financial psychology concepts that I think are very important for our viewers and listeners to understand because I think a lot of them have an impact on people's retirement lifestyle, planning, and investing. So I have a couple that I wanted to go over with you today, and I think it's going to be a really cool topic to discuss.
Well, so let's continue with what you have today with the psychology piece.
So I'll start off with number one. It's called status quo. And this refers to a tendency for people to stick with their current financial decisions or investments, even if there are some better options out there available. And I think a good example would be never updating a plan. Let's just say you started a plan, you put it in place, and then a couple of years go by and you've never updated or you never went back to updating it. And you just keep this plan, even though you're sticking to it, which is great, but you just never go back to it because, again, it's this financial psychology concept I wanted just to talk about, status quo, where you put something in place and you just keep it as is because that's just the tendency that people lean more towards.
Yeah, and you know what you mention it with investments and planning. We typically tell people to update their we update it dynamically, meaning if you get a raise today, you buy a new house today, we like to update it as that's happening in real time. Um, but we tell people to update it typically at least once a year. And then with your investments, I think mentally end up getting tied to a decision. So when you buy something and it goes down, uh, you typically want to keep it till it goes up because you're wrong if you don't, right? Versus, or your time researching it could have been wasted. And on the flip side, when it goes up and hits your target, then maybe you want to sell then because it went up and got there, but maybe you need to reevaluate and you don't need to sell. So I think that um, you're you mentioned sticking with the same decision, right, versus looking at changing. I think that the way I'm shifting that a little bit with the investments is just reevaluating your decisions along the way.
Yeah, that's a good one. And then I'll add another one. I think this is a good one, Roshan, where let's just say, and this could be again status quo. Somebody just comes up to you, Roshan, and they're like, hey, I want to retire at 65. Let's just plan for 65. And let's just say that's just you run the plan, you set up their investments, you get everything going in the first year. And then as years go by, they never update it, they never change anything, which again, it's perfectly fine if that's the case, that's what you want to do. But what I'm pointing out here is let's just say 10 years go by and your plan's still planning on for 65, but now the plan's showing that you can retire as early as 60. Understanding that is very important when it comes to decision making if you want to make any other changes. You may see, hey, I can retire at age 60, but I still want to keep the 65. Again, that's perfectly okay. Nothing wrong with it. But some people, let's just say they get stuck on status quo, never go back to the plan, they'll never get that information to begin with. And I think that's where the value comes for just understanding this and addressing it.
Yeah. So, and Adrian, I would actually disagree with one thing you said, and you're just being nice, and I'm not always known for that. But when you had said if someone did a plan and doesn't change it and stick with it, you had said that's okay. I would argue that it's not. And the reason I'd say that is your example is a good one. What if you want to retire at 65 and now you're on track for 60? Well, what if it's the opposite? What if you were want to retire at 65 and you're on track for that today? Something changes along the way. Your lifestyle goes up, the markets go down, and by lifestyle that could be new house, you have kids, cars, you name it, or you just want to spend more money, which I've seen people want to just spend more on themselves. So if any of these things happen, you want to capture that as soon as possible if your goal really is to retire at 65. What you don't want to happen is you're 65, you say you're ready to retire, you built a plan when you were 35, so it's 35 years later, you then get ready to retire and realize you don't have enough money and you have to work. And if you choose to work longer because you enjoy your work, it's not a financial decision, that's great. But if you're forced to work longer when you don't want to, just because you didn't update your plan over 30 years, that to me is not a position I'd want to be in, nor would I want to put my clients in that position.
Well, there you go, Roshan. I mean, you just addressed to our listeners and viewers how status quo can negatively impact you. So I
Yeah.
definitely appreciate that. And we can move on to the second one. And let me know if you've heard of this one before. It's called heuristic. And this is where it is a mental shortcut or a rule of thumb used to solve problems or make a decision quickly rather than doing a detailed analysis. And then the example I want to give to our listeners and viewers today is, let's just say you had a retirement plan at work and you're contributing to this. And then you decide to look at the different investment options and you say, hey, wow, this fund performed very well last year. Let me use this fund this year because it did very well last year. And that's how you make your decision. Again, this concept is called heuristic. And again, this is the shortcut. You looked at the fund, you saw how it did last year, and that was the decision making factor on why you chose the fund this year. And I think this is another important concept that people need to understand, where sometimes these mental shortcuts or these rule of thumbs that people use can lead to bad results. And again, sometimes they can lead to great results, but just being aware of it and understanding how sometimes these mental shortcuts and rule of thumbs that we can do may not always be the best decision.
Yeah, and Adrian, I am familiar with this. I am not a fan of these, just because uh, the one I thought you were going to say is that there's one out there that says you take your age minus 100, and that's the percent you should have in stocks. So if you're 20, 100 minus 20 is 80, have 80% in stocks. If you're 60, 100 minus 60 is 40, have 40% in stocks. Um, or there's another one out there where you look at your withdrawal rate. I'm going to withdraw 4%. So that's what I need for retirement. The reason I hate these is because it's so easy to get something customized and relevant to you nowadays. And yeah, granted, we're in the business, so talk to an advisor is one thing. I'd say we're definitely available to help. But beyond that, there's so many calculators and things online that's available to you, so you don't need to use these general rules. And I think you really should get something more customized. Your example of the investment with the fund, and looking at just the fund's performance, I think is spot on too, as being how much risk do they take? What do they own? Were they in a good sector? Is the manager the same manager that was there? What if the performance was great and then that manager leaves, right, or has left, and that's when you put it in. So I do think that in that situation, in that you just gave with the fund, if you were to just use the performance as a guide, I would personally say look at indexes versus the actively managed, because then I think it's the performance is then a better guide because you're really getting the overall economy and what's going on. But when you're looking at individual funds, I think it is problematic to look at just the one data point.
Okay, yeah. I mean, you brought up a really great point. So what I want to do now then is I want to jump to another financial concept I have, just not to validate why heuristic is a good thing, because like we said, sometimes it can work in your favor, sometimes they cannot. But you just said you're not a fan of these rule of thumbs or these mental shortcuts, especially when it comes to investment. So the next concept I want to talk about then is maybe the extreme, which is analysis paralysis. And
Mm-hmm.
this occurs when a person does what Roshan talked about for the fund, where maybe they're starting to overthink or excessively analyze a fund and they're looking at a bunch of information. But this ultimately leads to the person not being able to make a decision. So I had an example here, Roshan. I'm sure, do you want to hear it or not? But you gave a really good one with the fund, because that fund, for example, has a lot of information, as we know all investments do, where you can look at the manager, you can look at performance, you can look at each individual holding they have. And this can become so cumbersome for people to look through. It can keep them away from making a decision, or they might have been better off just doing that mental shortcut, picking a fund and seeing if it works out or not.
Yeah, yeah, and I do like this one that you had selected, an analysis paralysis, as in something to avoid. Um, I would say uh, you've got to be able to, like you said, make a decision. But I think you've got to accept that some of your decisions will be wrong, and that will give you the freedom to make a decision. Also, knowing that you're not locked into this decision forever, that you can change your mind. And I
Hmm.
think if you go into your analysis, the point of the analysis is to make a decision, not just to do the analysis, right? So if you have analysis paralysis, you're obviously being counterproductive to your end goal because you're frozen, you're not doing anything. So I would say make the decision, know that sometimes they're going to be wrong, and that's okay, but you can adjust. um, I think Elon Musk had a great quote on this that I wish I could find, but it was in the biography on him, which is a great one by Walter Isaacson. He says something to the effect of, a certain percentage of the decisions are going to be wrong, and that's okay, but you've got to try it because sometimes you're right. And I think one of the examples they used was it was using bolts to fasten. It was either with SpaceX, where you're looking at a rocket ship, or their cars at Tesla, and he wanted to use less. They were like, "Oh, it'll never work," and I think it actually didn't work, but trying his method found a way to make it more efficient anyway. So you've got to give it a shot. It was something like they thought they needed 10 bolts. He thought it could be done with 6, and eventually, because of his attempt at 6, they found they could do it at 7 or 8, something like that. But my point being is making that decision that in that situation they also were very skeptical of making, and they were unsure would work, did lead them to a better place.
I mean, that's a great example. I mean, the decision making factor with all that analysis, now you make a decision. I mean, sometimes that can be right, sometimes that can be wrong. But again, like you said, just ultimately deciding sometimes and just accepting whatever outcome is also something how you can really grow as an investor. So that's just definitely a great example, Roshan.
Yes.
So is there anything that you want to touch on before we move to the fourth one?
No, let's go to number 4.
So the fourth one is mental accounting. And for this one, I don't want to give the definition. I'd rather just give an example just to help our listeners and viewers understand it more. So let's just pretend I'm a client, Roshan, and I come to you for advice. Okay. Does that work? So I'm coming to you for advice and I'm
Yes.
saying, hey, Roshan, I want to go on vacation. I want to go overseas. So I'm really looking forward to this vacation. I can't wait to take it. And I have two accounts. I have an IRA and I have a savings account. And I say to you, Roshan, I want to take money out of my IRA account to fund this overseas vacation that I really want to do. So, what questions would you ask me initially? How would you kind of react to my decision of pulling money out of my IRA for this vacation? What would you say to me?
Well, I'd want to know what the vacation costs. I want to know what your tax bracket is, and what rate you'd pay when you took this money out. And
Mm-hmm.
if you'll end up paying more to access your IRA than your taxable account, I would explain to you why I think the IRA is not the way to go and the taxable account is. Or if your tax rate is better, if it makes more sense to take the IRA, I'd probably just tell you, that sounds good, Adrian. Let's take the money from the IRA and enjoy your trip.
Mm-hmm. And I'll get hit with a penalty taking money out of the IRA as well.
Oh,
As
oh,
well, that's also something to consider.
now,
And the
I didn't
reason,
consider that this was actually you, Adrian Nicholson, under
yes, this is
59 and
me.
a half. So
Yes.
yeah, if this was you at under 59 and a half, I'd
Mm-hmm.
probably still run the analysis to make you feel better. But,
Yes.
but I would initially start with pushback saying, Adrian, you're going to pay a 10% penalty plus taxes to take this trip when you have this other money just sitting here.
Okay. And then you gave me the analysis and you said, Adrian, the IRA is not the way to go. Use the money in your savings account. And again, this financial psychology concept is called mental accounting. So, Roshan, everything we just talked about, and I tell you, Roshan, I do not want to take money out of my savings account because that is only for emergency uses only. What would your response
Okay.
be?
So let's act this out. So Adrian, how much is the trip?
The trip is going to be $20,000.
Okay, the trip is $20,000. Let's assume you're in the 24% tax bracket, right? And let's add. So I would say, Adrian, what if this very same trip, if I told you, Adrian, I can get you in this trip and I got a great deal, you can pay 33,000 instead of 20. Will you still take the trip for 33,000?
As long as I don't have to take money out of my emergency fund.
So you would pay 33,000 to take it just to avoid money taking out of your emergency fund?
Yes, because when I set that account up, I told myself that account can only be touched for emergencies.
So is this trip worth $33,000?
Yes, it is. I've been planning this trip with my spouse for some time now. We want to go to Africa and do one of those animal tours in those jeeps where we can see. She really wants to see giraffes. I really want to see lions, and we just can't wait to do it.
So why not? Why? How about you take a trip for 10,000 now and 20,000 now, and take another trip for 13,000 later?
We're dead set on this trip, and we can just cut the conversation short right here. But I'm just really trying to show the example of mental accounting, Roshan, because what am I doing with my savings account in this example?
Adrian, you're being ridiculous. It's what I understand it's a psychological thing, but when I say you're being ridiculous, I don't mean you, Adrian, in real life. I mean this character, Adrian, taking the trip. I can't imagine a client saying to me, "I'd rather pay 33,000 for the trip," if it doesn't mean. I've never had that a conversation go that way, right? Not saying it's impossible, but it's just it's to me extremely illogical, and I think most people are more logical than that. So I can see your example, but I would conclude that conversation. My expectation was that they would say, "Well, why would I be paying 33,000?" And my response would be, "You'd be taking it out of the IRA." And if they said, "Well, then I can't touch this savings. It's just for savings. It's not the IRA." I'd counter with, "Well, this is money for retirement, not for a trip. So if you can't afford to take it on your savings today, you may want to consider postponing the trip till you can afford it. Because if you can't afford to take it out of your savings, you can't afford the trip."
Mm-hmm.
Uh,
And I
and
think
and
what's
this,
helpful.
well, let me make one more note. I'm sorry on this. That's based upon where they stand in retirement. If you're way ahead for retirement and it's your money and you want to be wasteful of $13,000 of it, I feel like I can fight the argument as much as I want, but then I lose my standing, right? Let's just say you're fully set for retirement and you have millions of extra dollars. They just happen to be in an IRA, and you tell me you want to take it from your taxable account. I feel like I can't say don't take it out because you've got so much extra anyway. If you want to be wasteful with 13,000, and I keep saying wasteful, that's probably a bad term. If you want to pay 13,000 extra in taxes and penalties early, and really only 10% is in taxes early, that's your prerogative, it's your money. But that's not what I typically see. What I typically see is someone is on track or even ahead of schedule, but the people that are in that group won't want to spend the extra money in taxes, and they take the money elsewhere. My last counter to you would be, take it out of your savings, and if there's an emergency, the IRA is always there as well.
Mm-hmm.
But I would try my best to help you make the what I think is the optimal financial decision in this case. Well, very long answer. I apologize, but Adrian, please continue with where you were.
No, you're giving a lot of great information, Roshan. I definitely appreciate that. And I know our listeners or viewers are like, then just give us the definition of mental accounting. What is this? And here you go. It is a behavior concept where people treat money differently based on its source, purpose, or how it's labeled, rather than considering it as a part of their overall wealth. So I think the most important concept or key word here in this definition is labeled. In my example, what did I label that savings account as, Roshan?
Emergencies only.
Emergencies only. And one thing too that you'd have to address here, Roshan, I feel like I had an advantage in this conversation because why? I got to talk to somebody like you that ran the analysis that said, "Hey, Adrian, this is why you shouldn't do it." So the fact that I had to talk to somebody that could give me recommendation, make a decision off that, put me in an advantage. But we know with some people that might not be the case, where they have this a savings account that they labeled as emergencies, that's the last place they would want to go, especially if they're not getting detailed analysis from a third party. So I think that's, again, why I thought that example was helpful. And what you also gave as far as your feedback, Roshan, was just as great.
I'm going to add to this. It doesn't necessarily add to mental accounting, but it really goes back to doing the analysis. I had a client a couple weeks ago say to me, I want to donate money to this charity, and I think we should donate it via stock. And she sent me an email, and immediately I wrote back to her, that sounds like a great idea. Let's just review it. We had a meeting coming up a couple weeks later. So I said, we can review it at our meeting, or do you want to meet sooner? She said, let's do it at the meeting. So at the meeting, we ran the analysis. And the concept sounds great. If you donate appreciated stock, you don't pay the capital gains tax. The charity then gets the money prior to the taxation. So theoretically, you can either give the same dollar amount you were giving, or you can give a little bit more offset by the taxes. Either way, it sounds like a win-win. Well, when we ran the analysis, and this client actually has cash available as well, so she has the option, donate cash or donate appreciated stock. When we actually ran the analysis, because she's at a higher income tax bracket, her deduction will actually be greater if she donates the cash versus the stock. So I bring that up with what you had mentioned about running the analysis to show the importance of that, because she thought it was a good idea. I initially thought it was a good idea. When we ran the analysis, we found that it was better to do it a different way. So just once again pointing out, I am surprised sometimes still with the analysis. I'd say the majority of the time I'm not, but it still happens a few times a year and enough where I wouldn't skip that step. So to everyone listening, I'd advise you to do the analysis on whatever financial solution or whatever financial problem you're trying to solve.
That's a great example, Roshan. I appreciate you sharing this. And as I'm looking onto the next concept I want to talk about, there might be some overlap here. So if you can help me with this one, Roshan, that would be great. It's called the endowment effect. Endowment effect. And this is a tendency for people to place a higher value on something they own compared to its actual market value, or what they'd actually pay for it if they didn't own it. And the example I have, which I hope lines up with an endowment effect, but I think this is a great way to do it. I'm going to do another example with you, Roshan. I'm not sure if I want to do it after the mental accounting one, but we got some great information from the mental accounting one, so I'm just going to go for it. So, Roshan, let's just say I came to you again, and then I said, hey, Roshan, I just finished working at my company. I have all this stock from my previous company that I own right now, and I just can't sell it. I can't part ways with it. It's just too important. I think it's going to go higher. It's just, I'd rather sell my own personal property at this point than sell this one company stock that makes up a good majority of my net worth, actually. I forgot to tell you that on our previous call. What should I do here? What advice do you have for me? I cannot see myself selling this company stock in my retirement. And don't yell at
Yeah,
me.
no, I won't, but I would just uh, try to tell the client that it's an investment, and you need to analyze it as any other investment, and never get married to the portfolio or the holdings that you have, because you want to be as objective as possible. The moment you already own it, you are already not fully objective because you own it. But I would, and this company stock you own might be a good stock worth keeping, or it might not. I would just, once again, what we said about earlier, analyze it. Now, had, uh, I've definitely had conversations similar to this. I'll tell you how I approach the analysis as well. Is if they have enough in assets where if that stock went to zero, they'd still be fine for retirement. I would explain that to them and then say, well, now you've got the option to keep it or not. On the flip side, if they have just enough for retirement, including the stock, I would spend more time explaining to them, you can't afford to have this much of your wealth in this one stock, because if this company stock goes down, you've got to go back to work.
Mm.
And are you comfortable knowing that there could for nothing wrong with the company, nothing wrong with you. The stock market just goes down, and now you've got to go look for a job, even though you've been retired for 5 or 10 years. And similar to the example earlier with the vacation, I tend to find people are more logical when you review it with them and explain it to them. Uh, but I have had people that say, I own this and I never want to sell it. But interestingly enough, the situations I've come across with that, typically that person has excess other assets, so they can opt to keep it.
Yeah, now that I think about it too, with the endowment effect, I guess the E can stand for emotion here. The emotional attachment is something that you have to address and work through. I think that you can see that a lot with a lot of these concepts that we're going into today. When it comes to financial psychology, when it comes to people's behaviors, their emotion, when it comes to certain things, it's gonna vary, and that's something that you at least need to address or make note of, just so you can avoid any decisions that are just solely driven by one particular thing. So, anything else you would want to add here, Roshan, before we move on to the next one, which I'm actually going to let you uh, explain to our listeners and viewers?
Oh God, what is the next one? I hope I can explain it.
It's herd behavior.
Yeah, I mean that in general is when people will do what other people are doing, especially in the investing world. There'll be a lot of talk about contrarians and versus herd behavior. Uh, what's tough about this one, and I've said this on previous episodes, is that there are multiple ways to make money in investing. There are people, and with herd behavior, I think more about technical analysts. Not saying they're necessarily a part of the herd, but what a technical analyst does is they look at a stock chart and they will typically try to follow the trend, right? Things that are heading up, it's breaking averages, so it will continue going up, and they'll do the same thing on the way down. It's going down, and that's what the trend is saying. A frequently used phrase or a common one is the trend is your friend when you're this kind of technical analyst. So they try to identify the herd through price action and then continue with the herd, whether it's up or down. So uh, what makes this one a tough one is my opinion on it is not as strong as some of the others, where I'd say, you know don't do this or that, or try to avoid this or that. I'd say with herd behavior, i I typically don't use that one looking at investments, but I know people who do and who have done it profitably. So I think you've got to find the investment approach that works for you, but you've also got to make sure there's substance behind it. Like the one, the tulip bulb scandal, or there was the other bubble where they were trading sardines, I believe, things like that, where there's really no value behind them. I think the herd behavior can really get you in trouble, right? And in today's world, um, there are people that will say that about some of the cryptocurrencies, and I hesitate even making that statement, because you've got to know that there's some good ones out there and there's some really bad ones out there, and so you've got to be careful with what you do. But it's the really bad ones that concern me, where there could be that herd behavior or mentality when people are trying to get into it, and then it's the greater fool theory, where you buy it and think there'll be a greater fool out there later that'll buy it from you. So there are definitely areas where I worry about herd behavior, but I think that as I said, I know people who've made money with it, so I wouldn't necessarily throw this one out completely.
Awesome, great. That's exactly why I wanted you to do herd behavior, because you talked about a lot of important things. You defined it excellent. And before we move on to the last one, is there anything else that you want to make note of on the previous ones we talked about? Any other things that you would want to touch on herd behavior, since we're on that one right now? I feel like we've got a lot of good content, and then we can move on to the last one.
Yeah, let's go to the last one, but I do want you to, at the end, please summarize all of them,
Yeah, of course. I'd be
or at
happy
least the
to.
review, or at least review the list.
Okay, yeah, of course. So the last one is narrative fallacy. And this is a behavioral finance tendency where people believe or rely on a compelling story to explain a complex event, even though this story oversimplifies or distorts the reality of it. And I think a good example I can use here would be in a sports analogy. And I think this is a good one or a common one where somebody says, "Oh, how was the game last night? How'd your team do?" And you're like, "Oh, we would have won, but our best player lost the ball at the end and we lost." And I think that's a great example too, because you could really push back and say, "Really? That is the only reason why your team lost? Is there
Yeah.
anything else that happened? It was a 1 minute play, and that's why the 60 minutes just didn't count." And I think that's a good example to use here. And it can kind of connect a lot to heuristic, where you make a shortcut or a rule of thumb, quickly say that one reason is why I made that decision on why we lost the game. Or another example could be, you can think about in the investing world, an investment or a stock. The company stock went down because they had bad earnings. That's why it went down. That's the sole reason why it went down. Where there's a lot that goes into it, why the company stock price went down, why they missed on earnings in the first place. So I think this is a really cool financial psychology concept, and one that's really relatable, where you're kind of ignoring a lot of details that went into the overall outcome that happened at the end.
Yeah, I completely agree. This is a great one. And I think the sports analogy was perfect because we all, I think, as all sports fans do that. And then when you really think about it, you're like, well, that one play wasn't why, wasn't why we lost, right? There was a
Yep.
lot of little things that compounded to get there. And the same can be said with investments, or you talked about missing earnings. The report, the earnings report comes out, and you'll see the opposite too. They beat earnings, but they missed revenues, or they hit earnings, but they and beat revenues and earnings, but gave a weaker guidance, which also are just short. Which also are short versions, or really can fall into the narrative fallacy, where I think you've got to look into what actually is going on behind the scenes versus the headlines, right? I think that I feel like this one is something that's increasing more frequently. I feel like a lot of times when you'll have a conversation with someone about anything, they'll give you the headlines, but not the substance of the article. And very often they don't know the substance of the article, but they want to hit you with something. So I think that narrative fallacy is a good one to make sure that we avoid in all walks of life.
Yeah, especially with a lot of information now that people have to go through, it can seem common. Just all right, what's the headline? What happened? What was like the pivotal moment? And just make your judgment off of that. But yeah, so I will definitely run through the list of all the ones that we talked about today. And I really appreciate your feedback on all this, Roshan. You gave some great examples. So the first one was status quo, and this is a tendency for people to stick with their current decisions, even if there are better options that are available. The second one is heuristic. This is a mental shortcut or rule of thumb used to solve problems or make decisions quickly rather than doing a detailed analysis. The next one I have on my list is mental accounting. This is a behavior concept where people treat money differently based on its source, purpose, or how it's labeled, rather than an overall part of their wealth. Next is the endowment effect, a tendency for people to place a higher value on something they own compared to its actual market value or what they paid if they didn't own it. Next is herd behavior. This is a behavioral finance that refers to the tendency for individuals to follow an action or a larger group, often ignoring their own analysis or evidence. Narrative fallacy, which we just talked about, in behavioral finance, is a tendency for people to believe or rely on a compelling story to explain a complex event when in reality the story oversimplifies or distorts it. And then analysis paralysis. This occurs when overthinking or excessive analysis of information leads to an inability to make a decision. And these all fall under financial psychology, which again, I think is just very important for our listeners, viewers to understand because it does impact a lot of areas in your life today.
Yeah, I completely agree, Adrian. That was a very good topic. You need to know yourself in order to manage your finances and invest as well. So, behavioral finance, there's a huge study, and there's some people that will invest purely based on that. Thank you, everyone, for listening. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, take control, and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arete Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arete Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arete Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arete Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arete Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw in Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.